I had a new person come in to meet with me. They dealt with another firm and they were complaining to me that they weren't making very much money. And so looked into their investments and found out they're actually doing okay. It's just that they were paying a lot in taxes. They had a bunch of GICs in their non-registered account, so any interest that was earned was being taxed. And they were frustrated because they felt like they were earning a lot, but they weren't really keeping a lot in the back end of the day. So I'm going to cover the types of taxes that we can pay and what investments are associated with each type of taxes. So first off is income. And so income is from when we work. And so we work, we get paid income. Or if you have a rental property, you get rental income. Or if you have GICs or bonds or something like fixed income, you get investment income. Also, if you own foreign companies and they pay you dividends, that's classified as income as well. So those are all income. And what happens with income is if you earn $1,000 of income, you look at your marginal rate, so not your average rate, but what the rate is for every additional dollar that you're making after all the other ones are made, and you pay taxes on it. So let's use an example. Person earns $1,000, they're in a 30% marginal tax rate. That means they're left with $700 to spend. So next one is going to talk about is capital gains. And capital gains comes from owning capital property. And capital property is like, not your primary residence, but like a rental property. You've held that for time. Gold, stocks, artwork, cars, anything that can go up in value, foreign currency. And so you've made some money on it. You don't pay it every year with capital gains. You pay it at the end when you sell it. And so if you bought a stock, you bought Tesla right in 2009 when it started, and then you sold a bunch last year, there's a huge capital gain. And so capital gains work with basically 50% of the gain you don't have to worry about. The other 50% goes on your income like you earned it. And so let's use an example. Same person, they have $1,000 capital gain. So $500 goes on their income, they're in the 30% tax bracket, so pay $150 in taxes, or they're left with $850. So capital gain is a good way to earn money. And then the last one is dividends. And dividends, I'm talking about specifically Canadian dividends, and even more specific, Canadian eligible dividends. And so let's just pretend all this is from stock market, you own stocks and you're getting dividends from that. That'll make it simple. And dividends are kind of nice because when you earn them, at the company level, they've already paid taxes on it. So let's just, a bank, they've earned a bunch of money, they've paid taxes, and now they're going to reward their shareholders with dividends. And there's already been one layer of tax already paid on that. So by the time that you get it, the government says, by the time you get it, it should be fair. And so the range actually of what you pay for dividends is quite nice. So at a certain level, you actually get money back for receiving dividends. So that's kind of neat, right? Like I'm going to earn money and the government's going to give you money back on top of that. Sign me up. And then there's a certain level, you earn as much Canadian dividends and you pay $0 on it. And so people like that, right? In retirement, that's great. And then the top rate is 36.54% for earning dividends, which is great because if you consider the top tax rate for income is 53.5%, so it's a lot less. So those are the three types of main taxes, and with that too, like the more capital gain, the more dividends, you're gonna have to take some risk, and so that's kind of the trade-off. The government rewards people who take risk with lower taxes, but you got the security with the income. If you have any questions, please reach out to me.